Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market update for Monday, February 12th, 2024. It's 4:13 p.m. now, and what I'm going to do is a little bit different. I do this from time to time. I kind of loop in some of the questions, but let's just go through. There were a lot I noticed today, even the previous posts I haven't even gotten to, but the posts I made today, we've got a lot of comments, some good questions, and as I said, this is, I've over the years been doing this long enough that you can look at the sentiment surveys. You can, they're out there, the AAII. You can look at put to call ratios. You can turn on the TV and see what they're marching out. But when it seems to reach that cacophony of bullish cries and almost anger, to me, that's usually when a big top's coming, not just a drop. But anyway, I'm going to go over this, and I need to repeat what I've been saying because, my goodness, when I look at some of these comments, it's like, okay, we've had a lot of trades in and out, a lot of short trades that didn't pan out this year, but my goodness, it's not like one, short trade that we've had in the beginning of the year. I'm going to address that too, and we're going to look at the last couple of years where we were at in the beginning of the year and so forth and that. And also, really, what I'm trying to do is, just to make clear, I will always share, and that's what I do a lot of talk about, kind of the bigger picture, where I see things going longer term, the longer term outlook. I still believe this is most likely a bear market rally in its final stages. And again, you can argue that all day long, depending on which chart you want to look at. And I'll go through a few. I'll look at some international indexes and all this, if I can get to that in this video. If not, I'll do that next. But you can look at all the other, it's basically one country, that's the U.S., that's at new highs. You look at all the other major, the G7, the big country, European countries, and all the other markets, and they're nowhere near. They're clearly still in bear markets. And it's not even that. It's not just the U.S. It's the pretty much the most unbalanced indexes in the U.S. When you go down to the small and the mid caps, and you include everything else in there, and you look at put an equal weighting on the large caps, and then forget about inflation adjusting it. If you do that, we're from where the market peaked back 2 years ago, or when it put in the S&P put in its previous highs 2 years ago, and it's at that marginal new high I've been talking about pretty much for most of the year being a possibility, most of last year, excuse me. Then it's down, but let's just get to that. Again, it's semantics, because you can sit here and cherry pick indexes, but when you talk about the stock market, really should be collectively all the stocks, is really what the stock market is. There are different indexes, and that's the best we can go by. And most of the bigger indexes that are the trading vehicles, the SPY, ES, or the NASDAQ 100, or the Russell 2000. Again, those are the ones we usually talk about. All right. So I already went over this. I just want to recap. A lot of stuff on the calendar. I'm going to jump ahead just because we're looking at the calendar. There was a question down here. Let me just roll to it here. Let's go down to that because I answered that last. All right. So good question, Mike. Should we wait until the CPI is out? How much weight do you see in this initial trigger down? Go in with a starter, wait till after the CPI. So again, great question. Here's my answer. Let me zoom in so you guys can see all this stuff. If I always held off on taking a buy or a sell signal in a trade due to an upcoming economic report, I'd never take anything because there's always another report right around the corner. I mean, this just happens to be a pretty heavy week on the economic calendar. That's why I pointed out today. And again, I point these things out. They're potential market movers. They could be just a non-event, continuation of what's going on, continuation of the trend if it's a non-event, or it could be an inflection point in the market, or it could build on the current rally. So anywho, that's that. There's always another economic report. For the most part, I tend to pass on or take smaller positions around earnings report, especially for that particular stock. In other words, I mentioned, that we have for IEP, it's a recent trade idea. They're going to report, and I think it's a couple more weeks. I mentioned that recently. And so, either close that, I'll either close that out or not add to. I took only a starter. But nothing. If I get within 1 week of earnings, I'm not going to take typically won't take a breakout. Sometimes I will. There's always exceptions. Sometimes if a chart is screaming buy or sell, I might roll the dice on that one and go into it. And then also on that, it gets a little deeper. I always say know your security. So if you're going to trade a stock, know that stock. Look at the chart. It's very easy to do so. Go back a quarter, and every quarter look and see if you're not familiar. Most of these stocks out there we cover, the Teslas of the world, and Apple, Amazon, and everything else. I've been trading for years, and you kind of get the ebb and flow. You get the feel of how much they can go up or down on earnings. On the big mega caps, Meta's a good example. Just did it. 10% is typically, it's not a hard ceiling, but that's about it. So you can kind of gauge, okay, if this thing goes against me, how much am I looking to, lose on it if I get stopped out? Because remember, the thing about stocks, trading stocks instead of futures, you are subject to gaps. You have pre-market and post-market, but that's very hard to maneuver. You can only use limit orders. And so in a stock can rip right past that limit order, and then you're still in it, and you're in the position. So it's almost impossible to avoid a gap that can really go well beyond your stop on individual stocks. So that's the point is earnings. Yeah, you want to. And again, some stocks really do such a good job of managing earnings expectation, or because of their business model, they're steady Eddie. And again, you can just look at a chart and go back and see what are their history post-earnings gaps. And then take your, if you decide to roll the dice and go into earnings, adjust your size accordingly. And then the other time is big FOMC meetings. That's the only other thing. That's the only thing on the economic count, typically, again, generally speaking. Big FOMC meetings where it's almost certain there won't be any surprises. That's okay. But there are some FOMC meetings that everybody's anticipating or not sure which way they're going to go. And that's the ones that can really move the market. So you just kind of have to get the pulse on, reading up and listening to, if you're a CNBC watcher or Bloomberg, you'll kind of know. Okay, enough on that. I just wanted to mention that. So, yeah, as far as today's sell signal, and then there was another question here. Where was it? About the sell signal we got today, which I'm about to get to. And I didn't see this one until well after I posted it. Hey, Randy, would you be willing to let us know when the QQQ minor trend line breaks? I'm having a hard time seeing where everything connects. Thank you. And then I did reply. I'd already posted that. Where is it? Where's my reply? Somewhere in there. I made a reply to it. It gets pushed down right here. So in this same thread, this is why I had a lot of comments I replied to in here. The initial earlier I posted, this is not refreshed. That's what we had. So there they are. That's the minor trend line. Solid sell signal triggered on break below the SPY minor trend line. So that should take us down here. And then this is the first target if you're swinging SPY or ES. And then I always say look at the ES charts and the SPY charts. If one of the two gets to the trend line first, you may want to, if you plan to cover there, or go long. Remember, I've been talking about this quite a bit, and I need to make it clear. My job, I provide technical analysis, and where my skill sets lie, I believe, other than looking, sometimes I'm hot with trade ideas and finding things that are moving. Right now, I'm not seeing a whole lot that's exciting me. But what I do good, I believe, is identifying key support and resistance levels that are very significant, that are likely, again, important. And what that means is twofold. If you're bullish, and I can see quite a few are now, it's an increasing number, and that tends to happen. Same thing, you can go long. And arrow breaks always denote where a reaction is likely. And so been a lot of, pretty vocal criticism about divergences and all that on the site. So if you don't believe that a trend reversal is likely, I've been doing this long enough, and I always say divergences are not, it's in no way, shape, or form 100% or guaranteed. It's just more often than not when you have these overbought conditions, divergences, other things that I don't even cover in all these videos. I've checked the short interest. We've been running for months now at the lows that typically accompany major trend changes. But again, I see a lot of you are bullish in rhetoric, and I know some aren't, and that's fine. Many don't even comment on the homepage, but there it is. So these levels that I point out, if you're bullish and you're looking, you think this thing's going to keep going, each of these are support levels that are likely to produce a reaction because of all the things I talk about, the overbought conditions, the divergences, the breadth deterioration, and everything else, including low volume. I got to check that a little. Sorry, just give myself a mental note to check my low volume indicator. I think it was firing today. It was looking to fire this morning. I have to update that. I'll get to that in a minute. But that's it. So there's support, and if you agree and you've been looking to get in, there's where you buy. And if you're a short seller, and you're not an active trader and you don't want to game bounces, then that's where you would add to on a break. I zoomed in here, guys, by the way. That's the October trend lines. I've been harping on those for quite a while now. That's what I'm referring to as the primary trend lines. This is a minor trend line. And then for those, like the subscriber in that question there where they said he couldn't see the lines, these charts, you can zoom in, you can expand on your browser. I used to have a little zoom feature. I've got to figure out how to get that back where you could scroll and zoom the charts. But I use a scroll wheel on a mouse. To me, it's a must. And on a Windows computer, if you hold the control button down, which I'm doing now, and roll that scroll wheel back and forth, you can zoom, and then you can pan as well. Right now, I'm not panning. Let me get back out of here. But and so the way to replicate these levels, you can see all you have to do is pull up your own chart using candlesticks, obviously, and that's what I'm using here, and then just replicate those trend lines, and you can see where they come in. Again, if you zoom in, you should be able to do that. Oh, very important too. If you're having a hard time doing it, make sure you have your chart set to log scaling. Okay, linear or arithmetic, they also call it, scaling will produce a different chart history, especially as you go back in time. So I almost always, I'm using log scaling on my chart. So there it is. And then that's the first target. If you care to short this market, fewer and fewer obviously care to right now. And that's usually when you get to the point where nobody wants to short, not literally speaking, metaphorically, that's where the big drops seem to come out of nowhere. But either way, and then there's 491.80. You can see a little minor support, so maybe a back test of the trend line. That's why I put these arrow breaks again, levels that are. And then if that goes, that should bring us down there to 480. That's 482.90ish. We'll call it 483, and then 478. Okay, so those are your levels. If you care to, again, either short and use those as price targets, if you're short-term trading, and there's another post on that too I'll try to get to. And then that was SPY. Here's QQQ, same thing. So when I put the solid arrows, bright yellow are always my primary scenario, and I was just kind of showing you here. I don't want to make it too confusing. That's why that SPY chart was straightforward. But any back test, the solid breakdown right there and solid 60-minute close. Again, you can see if I zoom in here in the video, let's move that over. Oh, you can see it right here on the edge. That's a solid 60-minute close. You don't have to squint to see. And when it broke down, that's a breakdown. And it happened, and that's why I made a point on both SPY and QQQ, which I wanted to see. That's somebody else's chart from the comment section. Okay, I was super zoomed in here. Let me go back to that. Back to the comments. Where we go here. So this is it, how we close the day. And this is showing the after hours. That's the white candle here is after hours. So there's your sell signal. And again, you can zoom in on the charts and you can see. So we have them both on SPY and QQQ. And at the end of the day, this should go without saying. And I'm going to tweak this trend line right here, guys. Sometimes I do that when I zoom in and I notice I'm not, when you on this charting program, when you roll and zoom in, I'm scrolling with the scroll wheel. Sometimes you get a little drift, but that's the better fit. I wanted to come in. Trend line drawing, I always say, is an art, not a science. I try to get the most number of reactions, either the bodies, which are the fat part, or the shadows, the skinny part. And there's two shadows, two bodies, and then multiple reactions there. So you can see a solid sell signal. And look, it either works or it doesn't work. And when it's a counter trend trade, especially in a very a rally that's just, this is one of those kind of relentless. It's just kind of grinding higher. We're not moving up much. We are down today, but again, we're grinding a little bit higher. And so just know that counter trend trades tend to have lower probability of success than a trade that is with the trend, in the direction of the trend. But you also tend to have, especially in corrective moves, pretty big and swift drops. In other words, when you do correct, quite often you drop and wipe out in a matter of a day or two. You can wipe out a week or more of gains. And so that's it. And it either works or it doesn't work. There's been plenty of those and plenty of longs. I'm going to get to that in a minute because I read the comments and I'm like, half the things I say just, they get disregarded, on all the pivots. So at the end of the day, I am a swing trader, but also a very active trader. I day trade, I swing trade. And so I'll talk about the big picture, and I'm going to get to that in a second. I just wanted to clarify there that we did break down, and that should open the door to that target. And then there's that trend line off the October lows right there. I'll make it yellow. I think I have it yellow on QQQ to kind of give it a little more significance. And then, of course, if that breaks, that's just a minor trend line. That's only good for if that primary trend line, that first target's hit, it's going to be about a 1.3 or so % drop. Again, assuming if and when it gets there. But then if that breaks, based on the scope of the divergences and all other things going on, I think we could see quite a bit more. And again, you see all potential targets here on SPY. And there's QQQ. Okay, let me try to go through these in order. This is just a comment. JFC, I don't know what that means. It's shorthand for something. Looks like those are short IWM. I'll get to IWM. We're still testing, again, the top of the range. And then, so someone says, luckily they didn't short it because Tom Lee, if CNBC has a price target, small caps up 50%. He seems to have a crystal ball and has been right in every call since 2022. That's funny because I know we have heard the name. I don't follow anybody. I kind of do my own thing, but he's obviously, because CNBC marches him out. And then somebody went on to recognize that. I didn't see that reply, but I did Google it. I did Tom Lee too, because look, here's my reply. Let me just say here. He is, again, when you think of Permable, at least in recent years, he probably takes the cake. And this is a known fact. It's not very complicated. The stock market goes up the vast majority of the time, right? If you go back 50, 100 years, because that's what it is. It's growth. It's companies growing. The economy is always going, forward in the long run. It's very easy. And so, any permable is going to be right more often than wrong. So, but really, when you look at the charts, so it's a quick glance at long-term charts will show you that if you can sidestep, which either go to cash in a bear market or even better, profit from shorting bear markets, you can lose years and even decades of gains from the stock market in mere months. In other words, if you just look at a long-term chart, and I'll do it right now for you. Let's pull the S&P 500 and go back long-term. This is well known. So you go back here and turn off all the lines, or we can go back even on a monthly. You can see back here, you had a bull market leading up to the 2000 top, big bear market, went up almost, made basically a double top, dropped again. So from this point, for those that bought back here, and this is important, it took, and again, we're still in what this was, by the way. This whole thing here occurred in what will go down in history as the biggest secular bull market probably in the history of the financial markets. And again, that has to do with, it ties into my longer term analysis, where you had the biggest secular bear market in interest rates. And this is the 30-year bond. This was the fuel for that bear market. So we haven't even seen this was the fuel for the secular bull market. And we haven't even seen what we're now seeing is, again, appears to be the very early makings of a new secular bull market in interest rates, rising rates, which we're probably looking at decades of subpar returns in the stock market. That would be if the call on rising rates, if the rates continue to rise, and it will not be a straight right up. This is a monthly chart. It's been swinging this as well. I talk the bullish talk on rates, bearish talk on bonds, but I've been long, short, long, short. I will, just like the stock market, try to zig and zag. I am not going to position for where I think treasury bonds or the stock market is going to be in 5 years. No, I'm gonna use the 60-minute charts and the daily charts, go in and out. But so back to the stock market. So you look at the S&P 500 peaking here, and so it didn't break out and take out those levels, and that's almost 14 years. That's 13 and a half years later, right here on the crosshairs. And so those are the nominal returns, meaning, if you had bought the S&P 500 index, not even counting the expenses of an index fund, let's just say you didn't even have that. Real returns are what factors in inflation. Nominal returns are without inflation. So inflation-adjusted returns is probably 18 years, 20 years where you made nothing in the stock market, and then we had this run up here. So my point is, you don't need me or anybody to tell you the stock market goes up most of the time. If you've got a 50-year time horizon or 30-year plus, you're almost certainly going to be okay. If your time horizon is less than that, or you're here to not only, maybe you're not even an active trader, but you want to sidestep that 50-something% drop, which was an 80% drop in the NASDAQ back then. It's not shown here because that's the S&P. Or that 55% drop in both the NASDAQ and the S&P, which again wiped out in mere months. You wiped out years. You wiped out all the previous bull market and then some. Here you also wiped out years of gains. And then right here we had the last bear. So back to that. Let me just go back to I just did a quick Google search because we haven't had a bear market, a real bear market. You can count COVID if you want, but it was over before we know it. So really 2007 to 2009 and then 2000 to 2002 were our last real bear markets. And then I still maintain that 2022 was just the first leg down of a new one. But if you want to call it that, by the way, so I did the quick measuring. So this guy, is Tom Liefeld, and I'm sorry, I usually don't even comment on whatever other people are saying, but this is important because, again, it just kind of goes to the, if somebody's putting a lot of stock in the guy that's calling for, big, huge gains in the small cap and saying he's, you go back and the first and only link I clicked on because I just wanted to see his call for 2022 because that, to me, was one of the most obvious bear markets, and we traded with near impunity, and even the bear market rallies from start to finish. And we came into the year short based on sell signals. It started out on 60-minute charts, but we had the divergences like we do now in the daily and weekly. And the S&P finished 2022 down about 20%, and the NASDAQ 100 finished the year down about 35%. And the video title was calling 2022 to be a record year, calling for new all-time highs and all that, saying a little soft in the beginning and a strong year to the end. And so, anywho, that's that. Now we just look at where we were as far as calls going out. I'll just zoom in on a daily chart here. We came into the year, if you go back into 2022, we came into the year short the markets, particularly the Qs. We right here, there's 2022. That's when that call was. We gamed all these bear market rallies, all the big ones, and then it was really my main trading vehicles, the Qs. So the markets bottom in October, and that was mentioned there, the divergent, the bullish engulfing candle at the bottom and all that, but it was right here. So remember, if you're looking at just year by year, we came into the year short, bearish, looking for a bear market, all out bullish in the beginning, right in the beginning of the year, with a focus on big tech, mainly the FANGs, listing Apple, Amazon is my favorite, bullish and long. Fast forward, they're called quite a few tops along the way. I thought the bear market rally would end it. I showed sell signals on the 60-minute charts. I gave upside targets. But on a lot of these inflection points, if you go back, I was covering shorts and going long as a swing trader, including coming into the year with sell signals that happened right before the end of the year. We came into the year, this is a daily chart, Here's January. We came into the year, right there was a trend line break. Here, I had it. It was on the 60-minute chart. There it is, that trend line break. Came into the year short. That was one of the biggest drops in months. And let's not forget, covered right there, hit the price target, and you go back, and all this is on the site. And again, it's just, the comments are getting to the point where it's like, as if these these things don't happen, these calls don't happen. So this is here, I'm all zoomed in here. Let me move this up a little bit. So where are we at? This is the third. This post is on January 3rd, and it's titled Euro US dollar price, precious metals and stocks likely to rally. So again, that was right after, so we came into the 2023 short, or 2024 short, just like we came into 2022 short. We came off the lows in 2023 long, came into 2024 short, but then turned around and covered and reversed it, and looking for a bounce. Admittedly, the bounce exceeded my targets. This is all the way down here somewhere. There it is. Posted on January 3rd, one day before that early biggest drop, in months occurred. And again, so these are levels that, if you were more bullish, you could have stayed long. I should have in hindsight, but hindsight's 2020. I don't, you trade long enough, you take these shots objectively, you're going to win some, lose some. And here it is right here. So that was back then. This is the same trend line, by the way. See, this is, and it doesn't look like much now. You take it back, but that's the rally, and that's the active trade. And this is what I'm trying to, this is why I spend so much time talking. And then at times it's like, some don't realize that. So we were short there. And at that point I said, you know what, I'm going to bounce. It's time to cover those shorts and go long. So it's not like it's been one short all year long or anything like that. And again, at the major inflection points, I don't even know, maybe not every time, most of the time, posted covering shorts, going long, and then looking for the next top. And I will continue. Things haven't changed yet. For months, if you recall, what my outlook was heading into the end of last year was that the market may have peaked, or my alternative scenario, which certainly is now the current one, is there was still a good chance that we'd see a marginal new high. And let's not forget, back here was all out bullish and long also. And that was the biggest, this is the move that just got everybody foaming at the mouth bullish right here. And although I didn't milk all of it or suggest staying long, we were covering shorts there because that was the purple levels. Remember those big purple levels I was talking about on all the market leading fangs right here, Microsoft, this purple line right here, and the 200-day moving averages. And so I repeatedly made a case to, that, hey, if we break it, and I was open to that, we break it, and then that's where we go all in. That's where I have those swinging trend shorts where we kind of tuck them away and push it hard. But I mentioned how important those support levels were. And so therefore, it's only objective when you fell to them, which we did, is go long. So, all right, just trying to clarify this stuff because, the comments are reaching that level. And let me see what else I can show you. That was the old one. That's when we were covering back then. So where were we at? So Tom Lee, okay, yeah. Maybe the small caps do go up 50%. If we, they certainly are at the top of the trading range again. They certainly could break out. And what it's going to take is interest rates most likely falling significantly because they are the most sensitive to rates. Semis are exploding. No, not today. I mean, I don't know. When I pulled it up, SOX is my go-to vehicle, was down today. So I wouldn't call that an explosion. But in reply to that, just like I said, again, this is where the last update I did on the semis, where I posted a chart, was a week ago. It was right here. This is February 6th. And I pointed out as both, pullbacks as an objective long entry. I said, me personally, I'm not going long. I think this is going to trend line break sooner or later. But if you're bullish, there's an objective long. And I made it clear what you don't do here. You either go long, you have one or two options on a pullback to a key trend line. You either buy it and go long, or if you're bearish, wait for it to break. And you had dual support, both the 580, 327. So that was a week ago. And so, you get these comments like, okay, if you think the semis are going up forever, buy it. This is the same trend line. This is the updated chart. So there we're at. The only thing that's changed, we bounced off the trend line, and the divergence is still very much there. And at some point, guys, if all these divergences go away, and especially, wouldn't right away go bullish. Sometimes I see divergences punch through. What I would need to see to really want to engage semis is some consolidation to work off the overbought conditions. I would rather, and I do it every day, I pass on a trade that I'm just not comfortable with. So this thing can go up and up and up. Again, there's the key trend line, and it's not mere coincidence. This is the exact same trend line we have on QQQ and SPY. And so that's what I've been saying now for the last few weeks. Until and unless these trend lines, SOX right here, the semis, if you're going to short the semis, you want to see that break, but you also want to see that same exact, there it is. This is the October low. It was a little later, right at the end of October, right here. But then you have the same trend lines on SPY and QQQ off their October lows, and they all need to go. So that's how you draw it. Log chart, log scaling, come off the October lows, come in, capture the bottom of these recent candles. And so that's it. So we have a near chart. We have a sell signal today. It's a minor trend line. So what does that mean? The odds of it playing out for a big drop. It could certainly be the start of something more, but you have a much more significant you will have a much more significant level when these sell signal when these trend lines go. Again, the primary uptrend line on SPY, which you can see here on the 60-minute chart right there, and on QQQ. So that's the update on the markets. That's the update on the semis. Small caps are really, there. You zoom out and you can look at it on a weekly chart. This is what it looks like. Here's that multi-month trading range, or year-long it's over a year. Big old trading range right there. We're still below that previous high. We're right at the top of the range. This is a weekly chart. If I will tell you this, I would not any bit above 200. 200 is the level I've been talking about. We're at 202.80 today. I would not add to or initiate a short. If you're in it, it's up to you. I personally would give it some room, and also based on where this chart is looking like. Me personally, I'm going to give it I have short positions on RTY. That's the small cap futures. And those are swing positions based on this. I'm going to give those and I want to see a weekly close. If something big happens intra-week, but I mentioned you have this previous reaction high from right here, a couple month or two ago. And then you have the next resistance up there at 209, which is the bottom of this trading range. And that one, you had that false break out there, and then the real deal on the downside, you back tested it. So there's the small caps, and if they can build on this, the fact that they did break out today, again, I mentioned it as an objective short on the breakout. I predicted the breakout would fail, which it did. And that was an objective short. That was even Friday, but not today, not back above there. This is not ideal. Once you have a failed breakout, usually that's it. So again, I want to be clear. I wouldn't add just, when you're short selling, you want a higher price. It's like buying the dip in reverse. You want a higher price, but this is a no-go for me right here. If it falls back down again, or if I decide to stop out and then it reverses, hits the next resistance or up there, I can always get back in. So I just wanted to give you that update there. Here's one, lithium. Someone asked, lithium ETF does seem to have bottomed, breaking out. It's a bit overbought on the 1 hour. Is it a buy on a pullback to 4160? So my reply, I don't know if they caught that the video I did. I highlighted, and it might have even been same subscriber asking about it. That's what put me on the lithium stocks. Then so the more I looked at them, I liked what I said. There's potential bottoming there, so I did a video. Anyways, there's a link to the video when you see this, so you can click it. So that was last week, and so lit in the lithium stocks looking like a potential bottoming play, even if only for a bear market rally. I don't see a strong support level. So here's my answer to: is it a buy on a pullback to 4160? I don't see a strong quote unquote support level. to buy on a pullback as it's just coming off of what could be a selling climax. I believe I addressed that in the video last week. And if so, that probably won't let the shorts out or the longs in. Selling climax, go down, get that washout move, and the shorts just you have a pretty good reversal and they just keep gunning it, and they don't give you, sometimes they'll give you, but quite often they don't let the shorts out easy or the longs get in. So there's the link to the video. Let me just cover this, the chart. And again, in that video, I go over some of my favorites. So you can, at almost any point in time, outperform an sector ETF by going long. If you're bullish on the sector, which of course you need to be first to go long any of the components, you can usually outperform by going with some of the best looking setups. But there it is. So there's that, you can see, turn off all the lines, see that last kind of washout on the increase. You can see the increasing volume bars here. That's indicative of a potential selling climax, a strong flush out, oversold, all the reasons, bullish PPO crossover, and it's been moving up since. So that was last week. I don't know. I can't remember what day. I'd have to go back to that. But so far we're up big. It's 9%. I mean, it's nice if you're active trading, but it's just lithium stocks are more volatile. And then on there on the list I had, let me see here. I think I covered them by market cap. So let me go over that. Lithium stocks. Yeah, here it is. And these are the ones I covered. Just I'm clicking on ALB. Like I said, some are pure play and some aren't. ALB, nice move off the low. So that one was highlighted there. So you can see, again, I'm not crazy about it, but it's certainly a nice looking setup. LAC, obviously, that's a pure play, and that one since last week is up about 20%. So, and like I said, I wouldn't be waiting for a pullback. It's a nice sector. You can get in here. Maybe add some trend lines here. Well, that one's already taken it out. So yeah, that looks good. It's a breakout. So these guys, and they give you targets on there. So check the video out if you haven't already. Yeah, it looks good. Just don't fall in love with it. It's lithium stocks are in a bear market, and maybe it's a bottom, maybe it's just a bear market rally. But as I said, I believe in the video, even if it's a bear market rally, you could be looking at, in just the sector ETF alone, 20, 30, all the way up to maybe 50%. That's really nice resistance up there. All right, let's move on. There's a lot of commentary where people think things are going. Something here, I'll just kind of throw out a little thing, what I will never allow this site to be is spiraling into political commentary, anything racial or anything like that. Anything that offends anyone else. So I don't mind if it's relevant to trading of the markets, but let's not get in here and start, right now, it's a clown show. I mean, both candidates, let's just admit it. I don't want to offend anyone again, but that is going to be a thing. And it's also amazing me that that this market's just pushing that off right now. Anyways, so yes, the election is tick, tick, tick. Right now, the market's not looking out that far, but we're going to see some volatility this year. And I think this just plays into where I think the markets are going. And I'm talking about the chit show in D.C. Let's see. Oh, yeah, next up, natural gas. Also, could you look at nat gas falling to extremely low levels, UNG, bullish divergence daily. Here's my reply. I've been watching nat gas, but I just can't make a strong case to step in just yet. Nice divergences building on the 60-minute chart, in the daily chart, but best to be extra selective. In other words, be picky on your entries on natural gas trades. We had one late last year, and what was it? We had a couple misses on it. And then, boom, the last one, I think it was 40% or so. But, it seems everybody just wants to trade the markets. A lot of the trade, I cover the markets more than anything because they are the stock markets. But a lot of these obscure trade ideas, orange juice futures and various commodities and crude, natural gas and gold and silver, which reminds me to do an update on silver for you. We hit the next target. But that's it. So I said, bump me again on it. I said I'd try to cover it, but that's it. I agree. You have the divergences here. Nope, UNG. UNG. Looks like a reverse split, and it drives me crazy. A TC2000. I love the charting platform, but they don't make adjustments for splits, and all your lines go away. Most charting platforms will adjust your annotations, your drawings, but you can see it right there. This is your divergence. But as I often say, divergence is not a buy or a sell signal. Just like a lot of people think it is right now. We have divergence on. Well, we have near-term, short-term divergences on SPY. I mean, short-term sell signals on SPY and QQQ as of today, and those may we rally back up and we pop back above those short-term trend lines, then those are negated and that trade considered stopped out. But on this, it looks like a potential selling climax may be in play, but don't ever underestimate how far nat gas can go one way or the other. And again, these are just unconfirmed divergences. That PPO is pointing down. You go to the 60-minute chart, you can see there, and I looked at the futures today, and I watch it almost every day. Actually, it's taken it out, the RSI divergence. So again, bump me later. I just I don't care to try to catch that falling knife. I'd rather be the second mouse on this one. Second mouse gets the cheese. And there, that's the last up we got on natural gas right there, and that was I forget where we were. I think we were close to the bottom. It was a 51% rally. I think we caught about 40% of that. But, a lot of folks, I don't know, maybe stay away from the Widowmaker. It can hurt you if you don't. And if you do take it, I always say, adjust your position size down. Nat gas easily goes up 5-10% in a day. I've seen it go up 15. It's one of the most volatile commodities. Let's move away from it and now go to what is an active trade, and that's silver. Okay, so silver was posted as an objective long entry. That means an active trade. Again, big difference between me posting a setup, which is a trade pending a breakout, whether it's a long side setup or a short setup, or an active one. This one was at support. And there's my primary scenario was the yellow arrows with an alternative that we could go down a little bit more. And so I said you can take it here or down to the 20. And or means take it here or down there, and means take a starter position here and down there. You scale into down but not below. That's what that means. And then if you took out that support, that's no bueno. And so that was the primary scenario. Had us going up here, hitting 22.57, 22.80, and then 23.9. And then right now, my final near-term target, 23.38. Again, we're looking at the futures. I'll get to the ETF in a second. Let me just go to the futures. And that's it. And this is how that works. These are the same targets. So we blasted through that first one, then hit that one, in which case I pointed to pull back. I did an update there. So that was the second target hit. We pulled back. You could have recycled back in on a pullback to that support, which was the first target. We went a little bit below it, went up, hit the next target, had momentum, and silver's pretty volatile, pierced through there, not even on a closing 60-minute basis. You can see, I'll zoom in for you, a little spike and reverse. So look at the reactions. That's again, this is where my skill sets lie in identifying these resistance levels so you can actively trade. And I know active trading isn't for everyone. You can even draw a little, some little trend lines, uptrend line. But you hit it. That's the first 60-minute candle. Tagged it, had a reaction, tried again at it, started to run, but just couldn't hold. That might have been a single trade or a very quick pop. But you can see that 60-minute candle, all four of them there, right there, closed right on that 23 level. And that gave you an opportunity to exit, or active traders game a pullback. We came all the way back to the level I pointed after we hit that target as an objective re-entry, and we bounced from there. And you can see where we stopped. This isn't mere coincidence. We pulled back to the support, which I originally had as a resistance level, and then bounced up to my second target, which was it's now resistance because we're below it. And if we go up there, what we need to do now is take out 23. And of course, that previous reaction high. But I think the next pop above 23 will do the trick. And that'll take us up, hopefully, to that last target. I don't see divergence right now on here on the futures, so it's still an active trade. I'll still maintain that final target. And I gave it to you as well for those of you that don't trade ETFs on here on the 60-minute chart. So we're up, since we nailed the bottom on it, and we're up, well, that's 2.3. I think it's 3.5 on the futures. The futures up more. And that was, let me go back to that. It's kind of what I want to do here is impress the importance of not only trading the stock market, because I swear by some of the comments. I guess that's for some people. Maybe you only want to trade the indexes, and that's fine. But trading here, so from 23, it was about a 3.5% pop just to the target. I measured it earlier. Here, let me do it again. All right, this is the measuring tool. The line's about 4. It's about 4% from where we went long to that target. And that was, when did we take that? I said that was silver. It was long on February 8th. Today's the 12th. So just a few trading sessions, so 4% there. And so, on the market's just going up a lot less now. That was the 8th right there, February 8th. We're back to where, so the stock market's gone up a quarter point. Well, right now, went up a little higher, went up 1.2%. So you can see that even if, you're swinging this thing and you're short the indexes and you take other positions, other trades, such as silver or the lithium stocks or, IEP, I told you, can't go too crazy because they're reporting, but that's up another 1% today after the breakouts. Again, not much. We're bare. I don't even consider that. And still, I'm told you I'm not crazy about the relatively. It was a little pop in volume there, but it's like anything. You take it, you diversify, spread your eggs around, don't put them all in one basket, and that's it. And you're hopefully over time you should have even if you had just a 50-50 win ratio or even less than 50% win ratio, and you're using an attractive RR, say 3-to-1 or better, then you're going to make money in trading. But you've got to spread it around, diversify different asset classes. Speaking of which, and this video is running long, I just want to bring up the Treasury bonds. And this is IEF, the 10-year, and we still have, again, it looks poised to potentially run, but there's cross currents. We're coming off a bigger divergent high, in other words, a much bigger negative divergence, but we do have some positive divergence there, and it's a good support. So this is a support level I threw out last week. We're still holding it. This could be, the way this goes will likely be determined by the economic calendar this week, starting with the CPI tomorrow. So watch that, and just know, like I say, I don't have a strong opinion. I do not have a position in bonds right now. If anything, like I say, the only case to be made right now would be long, because you're at support. You can make a case to short it here on the breakdown or on the back test right there, but your next objective short entry is that. And if we get to the yellow zone, remember, that's where I believe the stock market will start to finally take note that yields have been rising. The orange zone, they're really going to take note, and then the red zone is the market will start to freak out. And this is not a hard prediction with confidence of where we're going. It is merely what I do believe will happen if it does. So we bounce here, then, like I said, green zone is going to be net bullish for the stock market. So I would keep a chart up or just watch this from time to time. And as far as inflation goes, or the CPI, one of the biggest components of oil. We've had oil kind of ticking up. This is USO. But really, for the last year, we're flattish on oil. So the year-over-year number, from what crude contributes, and crude is a big component, but then they usually strip it out. They look at core, where they strip out food and energy, which is volatile. But either way, I'm not trying to make any predictions on tomorrow's CPI. I don't have a strong read. I used to, for a while there when inflation was running hot, you guys remember I would cover DJP every day, a broad-based commodity ETF, and tell you, based on this, it was a pretty good predictor of which way the inflation numbers were going to go. And lately, we've been kind of just moving mostly sideways. Like I said, the vast consensus, the 110% reason for the stock market rally is the general consensus that Fed has won the battle. They pretty much declared it without saying, mission accomplished, but he pretty much said it. And Wall Street is, even before he said it, it's priced that in, and maybe that's the case, maybe not. I don't believe so. I think we'll see a resurgence here. I believe it's just based on the technicals, among other things. It's a corrective wave, and even if not, you don't have to have. There is a case to be made for deflation going forward. Or even the big monster we call stagflation, which is, stagnant growth coupled with inflation. But anyways, I'm getting into the weeds now. You have the levels of watch. Let's keep it very simple. Take it, don't take it. We have 60-minute sell signals, nothing big, but sell signals on QQQ, first one in a while. And you know where the next one comes from. And if you don't care to active trade, then or if you not want to take that sell signal and you're bullish, and then these are all the support levels if and when we hit, where you can look to go along for that ride to the moon, or even if you think there's another 10-20%, but you've got to frame it in the risk reward perspective. And when you have the complacency that we have lately, the extreme bullishness, coupled with overbought conditions, divergences, low short interest, which I checked today, that sets the stage where you can have one of those pretty swift reversals. Right now, we don't have all we have is a very minor near-term sell signal, waiting that bigger sell signal on those breaks of those trend lines. And I'll continue to hunt for more trade ideas on the long side, like I told you I would last week. I'm just not seeing a lot out there that gets me excited in the equity sphere. So I'll continue to look at commodities and wherever else I can find them. And again, if you have anything you want me to look at, please throw it out there. A lot of the trade ideas that I come across on the site are from somebody asking about X, Y, Z or something. I look at it and I'm like, just like the lithium stocks last week. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.